What's up, family? It is Caden with Urban Finance. In this video, I'm going to be discussing everything that a beginning investor needs to know about getting started in the stock market. If you're new to this channel, I talk about everything related to financial literacy, investing, and urban finance. So if you haven't already, go ahead and smash the like button, subscribe to the page, and hit the bell to be notified of when I post new videos. All right, let's jump in. So the first thing that you have to do is pick your trading strategy. Now, your trading strategy can encompass the entire strategy that you use for investing in the stock market. Or another way to look at trading strategy is, are you going to be day trading, swing trading, or are you actually going to be investing for the long term? Because all of those require slightly different skill sets and should be for slightly different people who want slightly different outcomes in the stock market. So let's talk about day trading first. Day trading usually deals with selling or buying a security within a single day. And so you're looking for a quick profit. Most day traders typically trade via the Forex market or in the stock market, particularly with single stocks. For day traders, you really need to know how to read charts. There are day traders that trade based on alerts that they get from groups as well as news. So if a stock has really good news or coming out, they will trade based on the news. Now, I would say day trading should not be for those that are trying to build wealth or generational wealth in the stock market. Day trading is a tool used to build income. So if you need an extra $1,000, an extra $100 in a week, then day trading may be something you should try out. Now, personally, I do not day trade. When I first started investing in the market, yes, I did start off day trading, and a lot of beginners start off day trading because it does not require a lot of capital. But if you're over 25, I would recommend not day trading because it is not a strategy to build long-term wealth. There are individuals that have been successful day trading, but most beginners will not be successful day trading. Now, you can do whatever you like with that information. I am not judging. Now, if you want to trade regularly, swing trading might be something you consider. If day trading is akin to gambling almost, I will say swing trading is a little better than that. Now, I personally do swing trade with a very, very small percentage of my wealth. Now, swing trading, I will say that I do it for fun. Swing trading is essentially holding a stock for a short period of time. So that can be a week, that can be a month, that can even be, let's say, 9 months. I would cap swing trading at a year just because at that point you get into long-term capital gains, which I would consider a long-term hold. Some swing traders trade based on technicals only. So that is actually reading the charts and seeing where the best setups are. So for example, maybe they may see a support at $15 and the resistance at $20. And so they'll try to pick up the stock at $15.50 just before the stock hits its support, knowing that the stock will probably travel up very close to its resistance level. And right there between that $15 and $20 mark, they can make a significant profit and then rinse and repeat that strategy. Me personally, I like to swing trade companies based on technical and fundamental analysis. And I'll say slightly fundamental analysis because the companies that I typically swing trade aren't necessarily companies with the strongest balance sheet. There are companies that are growth oriented. So companies that may not even be profitable yet, but are growing at an exponential rate. And those companies are usually companies that I am okay with holding for a long period of time, even over a year. If I'm swing trading a company I plan to hold for the long term, potentially, I do not always need to catch it at the support level because I do plan to hold the company for a while. If you're swing trading a company for a very, very short period of time, you really want to catch that company at its support or when it's about to break out from the resistance. But that's a little more technical and require a little more experience. But that's swing trading in a nutshell. The last and final trading type strategy that we're going to discuss here is long-term investing. And so this is buying and holding a company for a long period of time. This is really the only type of investment strategies that I recommend to family members. This is because long-term investment has the highest opportunity to be successful. Day trading, I think of it purely for income. Swing trading, you can do income and also to build wealth to some degree. And then long-term investing is focused on building wealth. And so this is something that I would actually recommend to anyone. And I do believe most beginning investors should start off with a mindset of long-term investing. And as you learn more and more about the stock market, you may dabble in those other stuff. But too many people, I think, start off with the get rich quick scheme, and not to hate on that, but it can be very dangerous when it's the way you begin and the way you think about building wealth in the stock market. So for long-term investing, you should always start by investing in your retirement account, because there are a bunch of different tax advantages for investing within retirement account. And so that is the place you always want to start. Now, above or addition to retirement account, you may want to take out a brokerage account that is outside of your retirement account, and that works a little differently. So I would say for long-term investing, first, max out the company match. Second, make sure you're investing in a Roth IRA if you have that option available to you, and if you haven't passed the cap for a Roth IRA. And then above that, I will max out my regular IRA account. And above that, that's when I would invest in a brokerage account that is non-retirement. And these are treated differently in terms of taxes, and we're not going to get into that in this video. But I would say one of the reasons why long-term investors tend to do better than traders is because of the capital gain tax. Long-term investors usually pay a 15% capital gain tax when they touch their money, and traders tend to put a 30% capital gain tax. Now, again, there is nothing wrong with doing multiple strategies, but I would recommend people start, especially if you're a beginner, start investing for the long term. In addition to that, if you are a beginner investor, you should really consider investing in either an index fund or an ETF. Me personally, I love the S&P 500 index funds. So for example, within my retirement accounts is primary Vanguard S&P 500 index fund or Fidelity's S&P 500 index fund. And outside of my retirement accounts also are primarily ETFs and index funds. So primarily I will be building out Vanguard's VOO index fund as well as ARK's ETF. Now, beginning investors should really start off with index fund and ETFs. And as you get more experience, and then you can, if you enjoy it, invest into single stocks. That's one thing that I would say. Only invest in single stocks if you enjoy the process. If you do not enjoy the process of studying companies, reading charts, there is no reason to really invest in single stocks. And that's just being honest, unless you're trading for income. For every person that hits gold with a Tesla, there are gonna be 100 people that hit coal with a Nikola. And so that's the only warning that I'm gonna give here. If you are a beginner, start with index funds and ETF. If you're experienced, you can invest in single stocks or whatever you like. But beginners, ETFs are the way to go, the best way to make money in the stock market. Now, to summarize this segment in one sentence, if you are a beginner investor, you should not put more than 10% of your capital in single stocks. 99% of beginners will be more successful in investing in growth ETFs over single stocks. The next thing you will have to do is pick a brokerage account. And the reason why I started with strategy, and I hope you go for a long-term investment strategy, because that is the most successful for the most people. But after you determine what you plan to do in the stock market, you need to pick a brokerage account. Now, I call this my fun account or my play account, which is my public YouTube account, is my Robinhood account. I like this account simply because it is a simple investment account. And so if you do want to sign up for Robinhood, there is a link in the description. And so I would say Robinhoods are for younger folks and beginning investors because of its simplicity. Here are some things that I would not do with a Robinhood account. I would not transfer my retirement money into a Robinhood account. That's a no. Robinhood accounts for me is for potentially taking on slightly riskier investments, so investing in single stocks with small quantities of money. It is not for your retirement money. Now, if you're investing for retirement, Vanguard is my preferred vendor. And if you're doing retirement and as well as want to have a brokerage account connected to that, I will go with Charles Schwab or Fidelity. I personally have both of those accounts. Again, Robinhood, under 30, beginning investors, and primarily, I will even say for fun and to experiment. I also have a video on how to sign up for Vanguard, so I will leave that in the description for you. So if you're investing for the long term, dollar cost averaging is your best friend. And all dollar cost averaging means is the same way you invest into your 401k, consistently, regularly. That's what you do with all of your accounts. And so if you're adding $20 into your brokerage accounts every week, you consistently do that regardless to where the S&P 500 or whatever ETF that you bought is at, or even if it's a single stock. Dollar cost averaging says add that same amount every month, every week, whatever your schedule is. And that is one of the most successful ways to invest in the market. Now, dollar cost average works the best with ETFs and investments like the S&P 500 because those consistently go up over time. Now, when you're getting into single stocks, dollar cost averaging can become more risky, but we won't go into that in this video. So here are 4 places you can dollar cost average into the stock market religiously and be very successful. Vanguard S&P 500 fund. Second is QQQ or Power Shares Qs. And you can invest in that, dollar cost average in that, and be very successful. And one that is not as tried and true as those two, but I like a lot, is ARK's Innovation ETF. So that's RK. And obviously Charles Schwab's S&P 500 index fund or any S&P 500 index fund. Hopefully found this video to be helpful. I try to make it as simple as possible. It is probably one of my longer videos because I wanted to cover a couple of things that every beginning investor needs to know. If you have a family member that is looking to get started with investing in the stock market, feel free to send them this video. If you got anything from this video, go ahead and smash the like button. It really helps out the channel. Subscribe to the page and hit the bell to be notified of when I post something new. And like I always say, even in the midst of these crazy times, God bless you and remember to live your best life.